This week, the Australian dollar traded from around 76.50 down towards 75.25. It slipped on domestic data as well as the RBA statement. February retail sales was disappointing, coming in at minus 0.1% month-on-month. Some of this may have been due to clothing stores closing down and liquidation sales affecting prices. The weather may have also played a part, with an unusually hot February. However, the details showed that there was broader-based weakness. Discretionary spending in areas such as household goods, cafes and restaurants, and clothing was soft, while spending on staples such as basic food rose. This switch between discretionary spending and staples is a pattern typical of belt tightening, associated with pressures on household incomes as well as consumer caution. And looking at Australia's trade update, there was little lasting impact on the currency. The surplus of $3.6 billion was just below the December record of $3.7 billion. In February, it was driven by a sharp fall in imports and a small rise in exports. We expect further trade surpluses in the coming months. The RBA kept rates on hold at 1.5% this week, as fully expected. However, the commentary was a little bit more downbeat and the Aussie fell in response. While the RBA maintained there was ongoing moderate growth in the economy, there was a bit more concern around the labour market. They noted that unemployment had risen, there was only modest gains in jobs, and wage growth was slow. The RBA also paid considerable attention to housing, warning that growth in household borrowing, largely to purchase housing, continues to outpace growth in household income. This theme was repeated by Governor Lowe in an unusual dinner speech, cautioning against investor speculation in housing, especially when taking out large interest-only loans. This comes as CoreLogic data shows that home prices in Australia grew at the fastest pace since 2010, and in Sydney at the fastest pace since 2002. This highlights the RBA's struggle, trying to support a struggling jobs market while balancing surging house prices and rising levels of indebtedness. Westpac expects the RBA will keep rates on hold through this year and next, while markets have priced in around 15% chance of an RBA cut this year. In the US, we had the FOMC minutes. Members noted that the economy was evolving as expected, with upside risks. There was also discussion around the change in the balance sheet reinvestment policy, possibly later this year. Markets are closely watching the process of shrinking the balance sheet, which had expanded under the QE, or money printing program, as it could cause significant volatility in markets, especially in interest rates. Several participants, however, said that they saw fiscal stimulus as more likely in 2018 than this year, and they saw the US dollar, interest rates, and equities fall. The Australian dollar was volatile in response, but overall largely unchanged. Attention will remain on tax, infrastructure spending, and other fiscal policies in the weeks ahead. News reports so far have suggested that the size, scope, and timing of these policies will be underwhelming. Markets will also be watching for developments on the US debt ceiling, as well as a possible government shutdown, which should weigh on the US dollar. In Australia, the highlight of the domestic calendar is the jobs report. The RBA's recent commentary makes this a more sensitive report than usual. While there's month-to-month volatility, our jobs indicator suggests we should see a bounce back from the negative number seen in February. We also have housing finance, the NAB business survey, and the Westpac Melbourne Institute Consumer Sentiment Index to watch. In the week ahead, we expect the Aussie to remain mostly in a 74.50 to 76.50 range. We'll speak to you next week.